Introduction to inflation and stock markets. Inflation plays a crucial role in the performance of stock markets. Understanding the relationship between inflation data and stock prices can help investors navigate market conditions and make informed investment decisions. What is inflation and how is it measured? Definition of inflation. Inflation is the sustained increase in the general price level of goods and services in an economy over time. Measuring inflation. The most common measure of inflation is the Consumer Price Index, CPI, which tracks the changes in the prices of a basket of consumer goods and services. Key inflation indicators. Other important inflation measures include the Producer Price Index, PPI, and the Personal Consumption Expenditures, PCE, index. The relationship between inflation and stock prices. Inverse relationship. Generally, there is an inverse relationship between inflation and stock prices. As inflation rises, the value of stocks tends to decline. Eroding purchasing power. Inflation reduces the purchasing power of consumers, which can lead to lower corporate profits and weaker stock performance. Interest rate factor. Rising inflation often leads to higher interest rates, which can negatively impact the valuation of stocks, particularly those of growth companies. How do investors react to inflation data releases? Anticipation. Investors closely monitor inflation data releases, as they provide insights into the overall economic conditions and the potential direction of interest rates. Reaction. Investors typically react to inflation data by adjusting their investment portfolios, often shifting towards more inflation-resistant assets, such as commodities, real estate, or value-oriented stocks. Volatility. Unexpected or significant changes in inflation data can lead to increased market volatility as investors reassess their investment strategies. Analyzing historical trends in inflation and stock market performance. Periods of high inflation. During periods of high inflation, such as the 1970s, stocks have typically underperformed, as rising prices erode corporate profits and consumer spending power. Periods of low inflation. Conversely, periods of low and stable inflation, like the 1990s and 2000s, have generally been associated with strong stock market performance. Cyclical patterns. The relationship between inflation and stock prices is often cyclical, with investors adapting their strategies to changing economic conditions. Sector differences. The impact of inflation on different sectors of the stock market can vary, with some sectors performing better than others in high inflation environments. Factors that influence the impact of inflation on stocks. Interest rates. Rising interest rates, often a response to high inflation, can negatively impact stock valuations, particularly for growth-oriented companies. Consumer spending. Inflation can erode consumer purchasing power, leading to lower consumer spending and potentially reduced corporate profits. Commodity prices. Inflation can drive up the prices of commodities, which can impact the profitability of companies in certain industries. Monetary policy. Central bank actions, such as interest rate hikes, to combat inflation, can have significant implications for stock market performance. Strategies for investing in a high inflation environment. Diversification. Investing in a variety of asset classes, including stocks, bonds, real estate, and commodities, can help mitigate the impact of inflation. Inflation-linked bonds. Treasury inflation-protected securities, TIPS, and other inflation-linked bonds can provide a hedge against rising prices. Value stocks. Investing in value-oriented stocks, which tend to be less sensitive to rising interest rates, can be a useful strategy. Conclusion and key takeaways. Key takeaways. Inflation has a significant impact on stock market performance, with an inverse relationship between inflation and stock prices. Investor reaction. Investors closely monitor inflation data releases and adjust their investment strategies accordingly, often shifting towards more inflation-resistant assets. Diversification and adaptability. Successful investing in a high-inflation environment requires a diversified portfolio and the ability to adapt investment strategies to changing economic conditions.